Off we go live. Here we go. Yeah. Hi guys. Welcome. Welcome to the channel. And today we'll talk about should you save and invest your money. I see we have a few people joining in already, so welcome. Just make sure you guys can hear me, right? Yeah, sound is going through. Perfect. Okay, so all right, we'll start from the first slide. So here is your aim. You want to have your money and you want it to grow like we grow a tree, right? So the magical thing you want to do is you say, okay, I have some money, I'll invest it somehow, and hopefully after a few months, a few years, I could have that money basically. Right? All right. So today we'll talk about some different categories of investment and also what you can do to reduce your risk and while getting a decent return as well. Obviously, there's a trade-off between the two, right? So we will go over different categories of saving and investment, and together we'll talk about like what sort of risk would you expect to have with those sort of saving or investment, and also what sort of returns would you expect to see, right? All right, so we'll start from the first, right? So those you guys should all be familiar of. So first thing on the list is called savings, right? So saving is you earn your money like weekly or fortnightly or every month your paycheck comes in. Everyone should save a small, hopefully a portion of their income. So the way we're going to kind of break down this is we're going to put them into categories. So we're going to put, say, saving on here, and we're going to start a table. We're thinking about the risk levels, right? And also, what sort of return can you get on this sort of method of investment, right? So you got your saving, you put your into like a you put into your piggy bank, or if you put into like a core account in a bank. So typically, as long as you kind of look after your money, we'll say the risk is virtually there's like no risk. And the returns are close to nothing, right? Like no real returns, right? No real returns, right? So typically with this method of saving, your money will be going backwards, right? But what is good for? There's actually something that's good for this, right? The one advantage of saving is you can use your access to your money, right? It's like now, right? You can just, whenever you need your money, you can access it now, basically, right? So that's kind of the key advantage of this. And then we get to the next sort of investment, which is called term deposit. All right, so we'll put it on here. So term deposit. So what is the risk with term deposit? Well, if you save it with a typical commercial bank, I think in Australia, those term deposits are guaranteed up to a certain amount of money. I think it's like around 200 grand or something. I think in New Zealand, there's no formal guarantee by the government, but chances are the major bank in a particular country, the government do want to look after it. So I would say the risk of a term deposit is pretty much close to no. There's no real risk to it either. As you can see, the interesting bit is about the return, right? I've put NZ as an example, right? We can zoom into the returns. You can see the returns are not very good, right? So let's say if you're smart about it, you might get returns somewhere between 1 to 3%, right? 1 to 3%, right? And what about access to your money? Well, those could be months or years away, right? Away, right? Or you have to pay a penalty if you don't access early, but so yeah. Well, let's say it's months away, right? That's probably the fair amount, right? We're looking at 4 months, 6 months away, right? In this case, right? Right, so the next sort of investment we can do is let's talk about bonds, right? So people kind of, when you borrow money from the bank, or if you borrow money off someone else, you are kind of effectively writing out a bond, right, yourself, right? So you are sorting a liability, as we talked about in the last video. But this is you putting money in, so you're going and buying the bond, right? Someone is owing you money, right? So the bonds have this what we call fixed income market, right? So you could have like, so it's like bonds, right? And bonds kind of have two types. You could have the high risk corporate bond, the high risk, right? Or you can have countries treasury bills, right? Right, so it's kind of two categories. The high-risk corporate bonds, I will probably put them in as a medium risk. Depending on the company, though, I'll probably be putting on somewhere between a medium to high risk. And for treasury bills, you're borrowing money to a country, right? Like it could be you're borrowing to Australia, New Zealand, or to the US. The typical risk is pretty low, right? There could be some countries where the risk is a little bit higher, right? If the government not doing very well, where they're running a lot of deficit and not much taxation, well, then in that case, their risk might be a little bit higher. So let's just say medium, maybe too low, right? So if you at the low set of treasury, yeah, in fact, I'll probably put it as the same, like low to low risk, right? So the treasury bill you expect to get is not much more than term deposit in real terms. So that'll be around 1 to 4% here, right? And the corporate bonds, right? The one that you're lending to companies, right? Here it's like, because the higher risk is a lending to company, right? That still varies greatly as well. Like if you're lending it to a very stable company like Apple or Microsoft, they might just pay you 2% or 3%, right? And obviously there's some really high risk ones. If they're near the edge of bankruptcy, then their return could be 20 or 30%, but there's a chance you might not get your money back. So this return, it varies a lot, but typically it's around 2 to say, I don't know, 15%, right? Let's just put a number there, right? What about access to your money, right? So typically bonds are traded on a secondary market, right? So again, you can sell that bond to somebody else to recoup your initial investment. So actually, those returns are per year, right? Per annual, right? So access, if it's treasury bill, you probably can access it quickly, right? Today, right? And then if it's a high risk company bill, depend on how big is the company, it might be today or in a few days' time, in a few days. But notice the risk is often higher, right? Yeah. All right. So that's kind of the fixed term. So where you expect to get paid a proportion of interest regularly, right? And now let's talk about shares, right? Company shares, right? Or we commonly know the share market, right? So the risk for shares is a lot higher compared to a fixed term bonds, right? Because with bonds, they're kind of promising you a particular percentage return, right? But with shares, it's kind of the company's management is saying this is owning a portion of the company's future profit, or future of the. It's like a portion of the company, basically, right? It's a bit like what's shown in this photo here, right? This bunch of people, they all own a share of a big pie, right? Often with risk with shares, it can be quite high, right? It probably be between medium to very high, right? If it's a very small company, and yeah, a lot of small newly started companies, I think there's some statistics saying off my top of my head is maybe half of them would die in 5 years or something, right? So it could be between medium to very high risk. So notice when we talk about risk for shares, they are very high in the sense that you might lose all of your money, but there's also the chance you might have a huge return on it, right? So it's very hard to estimate the return that you will get from buying a company share, right? In the broad sense, right? But when you but what differs from buying company shares versus doing your job is typically people would only focus on one career or maybe 2 or 3 different jobs. When you buy company shares, you can actually buy a few of them, or maybe 10 or 20 companies, right? Shares. So on each one, the variation could be very great, right? So you might get somewhere between, say, minus 30 to plus 50% per annum for each one. But because you're buying a basket of them, you average them out. So your typical expected return might be between, say, minus 5 to plus 15 per year, right? That's just approximate numbers, right? And if you want access to your money, that's similar to company bonds, right? There are share markets. You can sell your shares and get access to your money straight away, right? So we talk about like constructing a few shares of stock, right? So share stock, right? So what about like a fund, right? So you might have a superannuation fund. You might buy into an ETF fund, or you might buy into a mutual fund, right? I think those are the 3 common type of fund people typically buy into. The risk with fund for superannuation, I think, is typically because like governments do regulate them a lot more rigorously, right? So often those are between low to medium. And ETF and mutual fund, it really just depends on what you buy. So that could be between low to high risk, right? So one thing you start notice straight away is risk and return are typically linked together, right? If you want to increase your if you want to increase your return, you have to some extent increase your risk to some extent as well. Like that's something you can't get away with. The idea about like investment fund, well, the idea is they want to diversify the investment so that you will still get returns similar to the high or medium or high or very high kind of investment. But because you kind of diversify it out into so many different areas, your variability in return become a lot less, right? So super fund typically we're kind of the return are typically between -5 to about +15% a year, and ETF and mutual fund they typically be -10 to like +25 or 30% a year, right? And with superannuation fund, you have to wait until your retirement or special situations, right, to access them. Often you can access them within a couple of days as well. Like it's dictated by the rules of when you can access them. And ETF and mutual fund typically will be very similar to today or a few days, right? All right, so that's kind of a quick overview. Do we have any? Oh, I see we have a few people commenting. Here, yeah. Yeah, I'll see if I can answer a few comments as well. Yep, so we have one person saying, it looks like it's a useful thing to have. They start to understand what I'm talking about. Well, great to know that you're liking this series of videos. We have another person asking about, can I see the comments? Yeah, I can see the comments as they appear on there, yes. Another one talking about, is it now the right time to change into a more aggressive kind of risky environment, like kind of investment? Often with investment decisions, it's very hard to time the market. So my recommendation is often figure out what risk are you willing to tolerate and compare with the return that you expect to see there. So do a trade-off comparison, but at the same time, always save a portion of your money in emergency savings, because you might just need it the next week or tomorrow, right? And if you put your money into term deposits, it could be months away before you can have access to your money. And if you put your investment into the medium or high risk investments, when you need the money, the market might be at a downturn, which is currently it is, so it may not be the best time to sell them. So always they have a spread of different assets for investment, probably be the best way to go about it. So save a portion in your savings account. Have some term deposit if you know that you definitely need money in 6 months or a year. You have a fixed time you need the money, and then the rest I would consider putting into a spread of that as well. Oh yeah, there's another asset class I forgot to mention. It's like which it will be a big topic by itself as well. So it'll be like housing. Also things like education, and etc. Right? There's a lot of different other assets classes. All right, so that's kind of all the time we have for today. I'll look forward to see you guys next time. All right, how do I end this video?